All right, so the call is being recorded. Welcome back. The last time we were looking at all these, we've been able to look at the modified internal rate of returns, and we looked at the various approach for solving modified internal rate of return. So we are not going to wait at that. We're not going to stop at that. Let's quickly go straight to free cash flow or surplus project cash flow. So this is where we are today now. So when we are talking about free cash flows or surplus project cash flows, what do we mean? Free cash flow is cash that is not retained or reinvested in the business. So when we talk about free cash flows, they are the cash that is not retained and reinvested in the business. Unfortunately, there is dispute as to what is included within the free cash flows, as can be seen from the following typical definition. The free cash flow is the free cash flow to the company is the cash flows derived from operations after adjusting for working capital changes, for investment, and for taxes, and it will represent the funds available for distribution to the providers of capital. That is the shareholders and lenders. So what are they saying? When they are talking about free cash flows, they are talking about that cash flows that is free, right? That cash flows that is free, that cash flow that you can give away to the owners of the business. So after you've settled all the other expenses, you've paid taxes, you've paid interest, you've paid this, you've paid that, you've finished paying everything. Okay, so that's net profit that is remaining. Okay, most times that is what we call the free cash flows. So let's look at it. They say the free cash flows to the company is the cash flows derived from operations after adjustment for working capital changes, for investment, and for taxes, and it represents the funds available for distribution to the providers of capital, that is the shareholders and lenders. Free cash flow is the cash flow available to a company from operation after tax, any changes to working capital, and capital spending on assets needed to continue existing operation. That is replacement capital expenditure equivalent to economic depreciation. So as can be seen, the main differences between the two definitions is whether or not to deduct capital expenditure, so required to expand operation. Throughout this note, the treatment will be varied as a reminder of the inconsistency. In addition, some authorities suggest that no adjustment is made for working capital changes in respect of short-term measures of free cash flow. So they now say that free cash flows is commonly used in financial management to calculate the value of a company and thus a potential share price as an indicator of company performance, as a basis for evaluating potential investment project using MPP techniques. So these free cash flows now, you need to hear about when they say the value of a business. There's a topic like that talks about the value of a business. Let me see if I can check it. Because if you learn this free cash flow very well, it's going to be very useful to you in a lot of places. So what are the things to note? The things to note is this. You can use the free cash flow method. You can use it for valuation of business. If you want to, you want to do mergers and acquisition, you want to do all those things. When you are looking at mergers and acquisition, we are looking at all those things. We are trying to get the value of a business. One of the things that is very paramount and very handy is what we call the free cash flows. They use it most of the time. So if you learn it now, when you get to mergers and acquisition and any other topic that relates to free cash flow, you discover that it's just like you are just doing revision of what you've been told before. So the key things to note: number one, after you've paid all the expenses that is allowable, that is due, okay, and then you now make provisions for capital expenditure. Okay, you also take care of working capital. You take care of you also make provisions for capital expenditure. Probably you have projects, like you have assets you want to buy. So this is what happens. You want to assess what is free, what money is free to us. So to assess what is free to us, you simply take your operating profit. When you take your operating profit, adjust for working capital. You know what working capital is? Probably you have a project that is ongoing. You need to continue to inject some fund into it, okay, to make the company like running costs, to make the company, to make the project continue to move. So you adjust for working capital. Another thing you also do is that you pay your interest. If there is interest to be paid, you pay your taxes. You also set aside some money for capital expenditure, provided you have made plans that, okay, I want to buy this plant, I want to buy this generator, I want to buy this asset. You always make plans for those capital expenditure. So whatever is remaining, they are free money. Those money can be shared among the owners of the business. Obviously, you will not share it with your directors, you will not share it with your staff, because those ones are earning salaries, okay? But you share it with the owners of the business, the shareholders of the business. They are the ones that share the free cash flows, okay? So there are two types, actually. Now, calculating free cash flows from accounting records. So how do we calculate free cash flows from accounting record? Now, for proper accounting information, I mean to say, free cash flows can be calculated as follows. You get your profit before interest and tax. Take that, your profit before interest and tax, right? Then the next thing, you less your taxation for the period. When you less the tax payable for the period, right, you are going to add non-cash items such as, so just like the way you normally do your cash flow statement, if you want to do your cash flow statement, remember, you take your profit before interest and tax, then you now start adding back non-cash items and all that. So that is how the format of this one also is. So what are you to take note of? You pick your profit before interest and tax from the question. Number two, you now less tax because it's an expense that you need to pay. When you less your tax, now, if you are trying to get free cash flows to everybody, right? If you are trying to get free cash flows to everybody, then you only less taxation. When you less taxation, you know that this is the profit we pick is profit before interest and tax. That means that we've not paid interest to the debt holders, right? Because we are trying to calculate what money is available for both the debt holders and also both the shareholders. So we are working on free cash flows to everybody, to the company. So what you do is that the only thing you're going to deduct, because the debt holders, they are also going to benefit. So don't deduct their interest yet. Just say profit before interest and tax, which is this. You now left only tax. The tax rate is your profit before interest and tax multiplied by your tax rate. You're going to get your profit. You're going to get your taxation that is due. The next thing you want to do is that you want to now add back non-cash items such as depreciation, such as when you value an asset upward, okay, all those things. When you also when you do, is it exchange gain and so on and so forth. So they are non-cash items. So exchange gain and all those things. So they are non-cash items and all this. But when we get there, we are going to see the list of them. Okay. So the first one is depreciation, which is very obvious. Depreciation, if you have a valuation of asset and all those things, so they are non-cash items. So you are going to add them back because before now, depreciation has been deducted before you got your profit before interest and tax. So you have to add back your non-cash items such as depreciation. Once you've done that, then the next thing you want to do is that you now say, do I have any capital expenditure that I would like to incur, okay, this year? Probably you've planned that you're going to buy a big generator that is going to assist you in your production, or you've made your mind that you're going to buy a plant. You now less set aside, because the money that you want to get is money that you can quickly go use and just spend as you like. Free cash flow is what we are looking for. So what do you need to do? You less capital expenditure so that you don't spend the money. Set aside that money you want to use for capital expenditure, move it first. What do you also do? Less increase in working capital, okay, and add decrease in net working capital. So what do we mean? You know that working capital is like you are setting aside some money. You are setting aside some money that they will use as working capital. Probably there's a project that is ongoing and they say, okay, we will need 5 million for the project, right? For working capital. So what do? You will let the working capital from the profit so that when you want to have free cash flows that you want to spend anyhow, you will not go and spend that working capital that you need for your project. So apart from you lessening your capital expenditure, you also less your increase in working capital. However, if there's a decrease in working capital, we will add it. Who can explain to me on this call why we normally add decrease in working capital? Somebody should explain to me. Can you hear me? Hello? Why do we add decrease in working capital? We are not responding, no. But you understand why we are lessening increase in working capital. You should also understand why we are adding decrease in working capital. The reason is because when, let's say, you had it in mind that in 2026 we need 10 million as working capital. However, you now discover that in 2026 actually you only use 5 million, right? So it means that there's money remaining. So you add it back, right? So before we have less 10 million, thinking that it's 10 million we need for as working capital. But we now discover that we don't actually need 10 million, we need just 5 million. So you have to add back decrease in working capital. Okay, so that is how, so we are doing less increase in working capital, or you add decrease in working capital. So that's how we have here. So then the next one, after you've done all these plus and minus, you're going to arrive at the free cash flows, not only to the shareholders, because remember, we have not paid interest to debt holders. So this is free cash flows to everybody, both the shareholders and the debt holders. Okay, so this is free cash flow to everybody. Do we understand it, everybody?
Yes, sir.
All right. So somebody should quickly read this question for me so we can all move on. Somebody should read this question for me.
HWT PLC has earnings before interest and tax of $225,000 for the current year. Depreciation charges for the year have been $15,000 and working capital has increased by $2,500. The company needs to invest $22,500 to acquire non-current assets. Profits are subject to taxation at 30% per annum. Required, calculate free cash flow.
Okay, so thank you. All right, so here there's this company, they call it HWT, and it has earnings before interest and tax of this amount. So all you need to do, just take this template, okay? We just say earnings before interest and tax. We put it here. This is 225,000. Then the next thing is we now come and do what? Now, because we are trying to get free cash flows to both equity holders and debt holders, we only taxation, and taxation is going to be 30% of our earnings before interest and tax. So 30%, this is the tax rate. So 30% of our earnings before interest and tax is going to be 30% of 225,000, which is going to give us 67,500. Now, the next thing we're going to do, when we do our plus and minus, we are going to have so that is that first. Then the next thing we want to do is that we want to now add all the non-cash items. So you now go to the question, where is our non-cash item? We know about our earnings before interest and tax, is it value? Then, and it's for the year. Then they told us that the depreciation charge for the year is also 15,000. So you ask yourself, the depreciation, is it a cash item? No. Why are they not charging cash for it? Why are they charging money for it? So what do? You add it back. Okay, add back non-cash item, 15,000. Depreciation does not involve the movement of cash. When you are charging that depreciation, it's not like you went back to the market to go and buy the asset. The asset you've bought it already. The asset is even on your premises. There's even no evidence that the asset has been depreciated. Okay, but for accounting purpose, we normally charge depreciation. However, the taxman does not allow it because the taxman says the method for which we are charging depreciation is not uniform. This company is using straight line method, and that company is using some of the year digits, and that company is using reducing balance method, and so on and so forth. So it's not looking uniform. It means you can have the same class of asset, you can have the same amount, the cost of the asset, and then you can have the same useful life, but the amount you're going to charge in your profit and loss account might be different from each company that is having the same class of assets. So the taxman does not give us depreciation. In place of it, they give us capital allowance. But this is not tax we are doing. And as well, this is cash flows. Cash flow statement has to do with only cash, movement of cash. So what do? When we have gotten our earnings before interest and tax to be this amount, we now less only taxation. And why are we not lessing interest? Because the free cash flows we want to get is the free cash flow that belong to both the debt holders and also the equity holders. So that's why we did not less interest. Okay, just like the way we've not less dividends. So if you have not less dividends, you have not also less interest, because the free cash flows we are trying to get belongs to both equity holders and also debt holders. So what do? You take your earnings before interest and tax, fine. You now less your taxation that you have calculated, which is 30% of 225,000. You have this amount. Then the next thing, you now add back all the non-cash items. Depreciation is number one. You also ask yourself, is there any capital expenditure I would like to go into? Maybe I've made up my mind that I want to build a dam. I want to buy a tractor. I want to buy a trailer. I want to buy a big generator plant. Okay, so any capital expenditure you want to buy, set aside the money, because the money that you are looking for is money that you're going to use to do faji. So you take aside that capital expenditure money, take it aside, you less it. Then the next thing is that you also need to now check your capital allowance. Do we have increase in capital allowance? Sorry, did I say capital allowance? Sorry, working capital. You need to also check your working capital. Do I have an increase in working capital? Do I need to continue to invest in this project? Do I have an increase? If I have an increase, that money that I will need, okay, set it aside. But if it's a decrease in working capital, you will also see it. So since it's a decrease, that means that they did not finish using the money. The money was even excess. So we need to add. But because here they said categorically that you have an increase in working capital by this amount, so since it's an increase, that means that there is an addition. You need to have additional money to be able to fund that project. So what do? You are going to keep that side money away so that you don't go and spend the money. You set it aside. So we now less increase in working capital. At the end of the day, you take your 225,000 minus 67,500 plus 15,000 minus 22,500 minus 2.5 million. Sorry, 2.5,000. Sorry, what am I saying? Minus 2,500. I mean to say that at the end of the day, you are going to have your free cash flow. Now, for you to know whether this free cash, who these free cash flows belong to, for you to know, you discover that in this our computation, we've not paid anybody any interest. At the same time, we've not paid anybody any dividend. It therefore means that these free cash flows that we have belongs to both the debt holders and the equity holders. Okay, so that is the free cash flow to the company. That's what they call this. Okay, now let's now go into specificity, to be specific, right? We are now looking at free cash flows to equity holders alone. Okay, free cash flows to equity holders alone. So in this kind of situation, when you are having free cash flows to equity holders alone, it means that the only thing that you will not deduct is dividend. However, you see that your interest, you will deduct it, because the free cash flows that you are expecting does not belong to the interest holders. It only belongs to the equity holders. So you have to charge your interest in this kind of situation. So anytime they're telling you free cash flows to equity alone, it means you are not going to, you are going to deduct your interest before you deduct your tax. So they say free cash flows to equity represent the funds available for distribution to only ordinary shareholders of the company, where a company finance a project by issuing debts. Then the shareholders are entitled to the residual cash flows after meeting interest and principal payments. Okay, so after you have met the interest payment and also the principal repayment, right? So they say the residual cash flows is called free cash flows to equity and is calculated thus. So how do we calculate it? We already know that we need our profit before interest and tax. We pick it, fine. Now, because the free cash flow we are trying to calculate does not belong to the debt holders, it only belongs to the equity holders, then pay the debt holders their interest. You pay them their interest, then you also will pay them their loan, the loan that they took from you. You need to repay them. Okay, so you pay them their whatever. So let's look at it now. We now say, okay, you are lessening your interest, you are paying them their interest. Then the next thing, you are lessening their taxation as normal, the way we normally do. Then you also add back non-cash items as we normally do. Then you also less capital expenditure as we normally do. You also less increase or you add decrease in working capital as we normally do. Then there are certain things that are now added. What you now add is that you have three different, no, I think it's two things. There are two extra things. Apart from you deducting your interest, you also check, you add the cash raised from the debt issue. Okay, you also less debt repayment. Now, you know, you raise a debt, you raise a loan note because you actually needed money to finance the project. So that loan note, or that whatever the debt you issue that make them give you money that you use to fund your project, you are going to add it here. You add it. When you add it here, then you will now less the debt that you repaid. For instance, probably we collected, let's say we collected 50 million, right? We collected 50 million, and out of the 50 million, we've only paid 20 million. So you take the 50 million that we collected to show that our debt, sorry, to show that we collected money came into our account. Then when we start repaying back, how much have we repaid? The debt that we paid, you less it from it to know what is outstanding. Yes. So you less the debt, you less the debt repayment, right? When you less it, then whatever you have left is what you're going to call your free cash flows to equity holders alone. Since the debt holders, they've been properly accounted for, you've paid them back their loan. That is, you pay them back their loan, fine. Now, because Now, you know that when we are listing something, it simply means that it's an expense, right? We list it, okay? We pay them back their loan. We settle them. We pay them their interest. We also settle them back their loan. So that is that. So it's going to be in and out. The money you took from them is going to come in. Then the one you have paid to them will go out. Okay, in and out. That's how we're going to treat it. So it's only three things that makes free cash flows to the company and free cash flows to only equity holders to be different. When you are getting free cash flows to only the equity holders, it means you want to settle off the debt holders. So to settle off the debt holders, you must pay them their interest. You recognize the money you collected from them, recognize what you have paid back to them. So that is what that is. So let's now, once we have done with that, we now go straight to what we call dividend cover. We go straight to what we call dividend cover. Okay, so they say free cash flows to equity provides a more meaningful figure more than the earnings in the calculation of dividend. You know, when you're trying to calculate dividend cover, you're asking yourself, how many times can the is it the money made? How many times can we pay our dividends? Probably the residual money that's remaining. How many times can we use that to pay our uh, to pay our dividends? Okay, so that is dividend cover. Okay, so free cash flows to equity, they say it provides. Now, because the reason is because when you are using your net profit, which is your accounting profit, for instance, to do that, you be there's a lot of things that will be inside the accounting profit. For instance, there will be some cash items that you have deducted. There will be some unrealistic money. For instance, you can have like what do we call it? We can have um interest rate, gain on interest, gain on interest exchange. Sorry, gain on yes, gain on currency exchange, which does not translate to cash. As you're having those, you are saying there's a gain, but the money we can't see it. Okay, so all those things, all those yama things that you've done when you're doing your accounting profit, if you use that one to calculate your dividend cover, you will not be having a realistic amount because we are saying how many times can we pay our dividends from the profit that we made, the net profit that we made. So you are going to use that for your dividend cover. But they say it's more realistic when you use cash flows to equity to calculate it because you already know that equity people, you pay them dividends, right? And that is why you're doing dividend cover. Free cash flows to equity also shows the money that is available to equity holders. So they say free cash flows to equity provide a more meaningful figure more than the earnings in the calculation of dividends. So more than the calculation of dividend cover or dividend cover in cash terms and can be calculated as follows. So when we are trying to calculate dividend cover, they say it's better we use free cash flows. So we just pick your free cash flows to equity divided by the dividend paid or the dividend payable. Okay, so free cash flows to equity divided by the dividend that is payable. You are going to get the numbers of time that this your free cash flows can pay or settle the dividend liability that you have. Okay, that is fine. Let's now move on to the next question. Can somebody read for me? Can somebody read this for me?
The following data relates to MLX Limited. Forecast income statement for the year. Revenue 1,950. Cost of sales 1,314. Gross profits 636. Operating profits 122.50 kobo. Earnings before interest and tax 313.50 kobo. Interest charges 24 naira. Profit before tax 289.50 kobo. Corporation tax at 35%, 101.32 kobo. Profit after tax 188 naira 18 kobo. During the year, loan repayments are expected to amount to $60 million, depreciation charges to $30 million, and capital expenditure to $60 million. The dividend payable is $30 million. Required, calculate free cash flow to equity, and dividend cover based on free cash flows to equity.
Okay, so can we attempt this? Can we attempt this question as a classwork, or should we check it?
Let's try attempting it.
Okay, you guys want to attempt it?
I'm the only person speaking. I don't know for the rest.
Okay, so everybody, let's attempt it. So let's do like let's do just 10 minutes. All right. 10 minutes should be enough. Even 5 minutes should be enough. So let's attempt it, everybody. I'm waiting. So by the time it's 3 o'clock, then we now come in, we set in. So let's attempt it, everybody, quickly. Eight minutes more. So are we done? Okay, we have 5 minutes more. So I believe we are all attempting it. When you're done, let me know. We have 4 minutes more. Okay, so somebody said I should please help share something. Let me see. Please help share the format. Okay, no problem. Let me share. Yeah. So if I share the format, then you will not see the question. Okay, how can I do it? Or because if I share the format, you won't see the question. And so maybe you should just screenshot it, screenshot the format, then I go back to the question, or any how you want to do it. Do you want to screenshot the format and then I go back to the question?
Okay, sir. I'll screenshot it.
Okay, so everybody should screenshot the format if you want to, so that I can go back to the question. You have 1 minute to do that. Okay, so let me go back to the question. All right, so this is a question. So how many minutes more? Has anybody finalized it, or you need help? Has anybody finalized, or you need assistance?
Let's go on, though I've been able to calculate some. So let's go on so that we can
All right. Okay.
know if we are correct or not.
No problem.
Instead
So
of
let's
repeating.
check.
I think our time has elapsed. All right, sir.
Yeah. Thank you. Thank you. Yeah. So thank you for that. Yeah. So what we have is very simple. All these things are very simple. Just take your profit before interest and tax, which we have over here. We have your profit before interest and tax. Don't also forget that we are trying to use we are trying to get free cash flows to everybody. The first one we are trying to do is to get free cash flows to everybody. So that means that you're going to do it twice. The first one is you're going to do free cash flow to everybody, which is going to be your profit before interest and tax. You only less taxation. So you only less taxation. So your taxation will be at on this amount, not this taxation. It will be on this profit before interest and tax. The reason is because we want to get the total free cash flows that belong to everybody and not only to the equity holders alone. So once you have done that, then you minus your taxation. Once you minus your taxation, then you now add back all the non-cash items. The non-cash item obviously is depreciation. So they gave us the amount for depreciation. Depreciation happens to be 30. So we believe that all these things are all in millions. So 30 is the depreciation, you add it back. Then the next thing is you want to ask yourself, do we have any capital expenditure that we want to incur? They say, yes, we have 60 million. So you add back 30 million, you less 60 million, then you also, yeah. So once you have done those two, because we're trying to get for the both equity holders and shareholders. So once you have done those two, okay, you now also check, is there working capital information in the question? Because you need to check if there is a decrease or an increase. If there is an increase, what do? You less. If there's a decrease, you add back. Okay, so when I come over, that is for when you're doing the free cash flow to the total company. However, if you are doing free cash flows to only the equity holders, what do? Pick your earnings before interest and tax as usual. Once you pick your earnings before interest and tax, the first thing you deduct is your interest. So you now deduct your interest, which is 24,000. Once you've done that, then the next thing you deduct is your tax. Okay, you also deduct your tax. Then you now add back non-cash items, which is going to be depreciation. You less capital expenditure. You check for increase or decrease in capital allowance in working capital. Sorry, and at the end of the day, you ask yourself, how much did we borrow from these people? How much did we borrow? Did they tell us? Let me see whether they told us. So they say during the year, loan repayments are expected to amount to 60 million. However, did they give us information about the loan amount? No information. Okay, no information. So let's see what was done. So here, just like I said, you have your earnings before interest and tax, right? You less, because we are calculating free cash flows to only the equity, or to the company. You now take your earnings before interest and tax, you have it here. You now less your taxation. But if you were to do free cash flows to only equity holders, then you might need to pay for less your interest. Then you also take note of the loan repayment that you've done. Okay, so if you check the question, they give you loan repayment. You check the question, they tell you the loan amount that you also took. Then that is going to help you a lot. Okay, so yeah, we have this value. Then we had back non-cash item depreciation of 30. Then we less our capital expenditure of this amount. There is no working capital in the question. We did our plus and minus. We got 173.78. Who got this one? Who got it among us?
I did. I got it.
I did. Are you sure you got it?
Yes, I got 173.77 instead of 78. I think it's
Okay,
the approximation.
Okay, so you tried. That is good. So you got this one. So did you attempt the other one?
Yes, I did. Or got stuck.
What did you? Okay, you got stuck somewhere. This thing is very simple now. What is making you?
I'm looking at where to fix the dividend payable.
Okay, so that dividend payable, you are going to use it actually for your cover. Look at it. They say dividend cover based on free cash flow. So you are going to use it for your dividend cover now.
Wow.
Have you forgotten?
I just remembered.
So we now come over here. If you are doing the other one, then we need to pay our interest. So we now pick, instead of us picking profit before interest and tax, we only take our profit before tax. That's what we're going to take. Since now we are trying to get only the profit that belongs to only the equity holders. So we have paid our interest first. We paid our interest, so we now pick a profit after tax, which is we pick here, to show that we have paid interest holders their interest. Then the next thing is you now add back the non-cash items. The next thing, you less capital expenditure. You also check, is there what we call working capital? If there's working capital, if it's an increase, you less it. If it's an addition, sorry, if it's an increase, you less. If it's a decrease in working capital, you need to add back. So once you're done with that, then once you're done with that, then the next thing you want to do is you want to now check whether there is any loan that you took. Any loan that you took, you need to add it to this one. Then when after adding that one, you now less the repayment. Once you less, you do your plus and minus, you're going to get free cash flows to only the equity holders. They say, or solving straight from our result of the first computation. You can also solve straight from here, okay? Knowing that the only difference is that the interest that we've not paid, you less your interest. Also remember that if there's any loan amount that you took, you need to add it. Then if there's any repayment, you need to less it. So those are the three things. Look at it. We just pick that free cash flows, which is this value, right? Then we check what is the loan repayment amount. We are going to less it. Then I'm coming on. Aha. So our interest now, our net interest. Okay. So our net interest. I want to see what they did here. Why they are having these
Sorry, please, I have a question. I've raised my hand.
Okay, I can hear you. Go on.
Okay,
Hello.
firstly, the debt. Can you hear me?
Go on. Go ahead.
Okay, sorry, can you put on your screen back so that I can
It's from your end, though. Others can
listen
see
to
my
what I'm
screen.
saying? I can't.
Others can see my screen. It's from your end. It's from your end.
Okay, I
Others
wanted
can.
to talk the debt repayment. Okay, it has come up. The debt repayment, is it 69 or 60? Yes, I think I have 60.
Okay, let's go and check it. Let's
Thank
check
you.
it. Debt repayments. And the question. Is it the question?
Yes, please.
Yeah, so it's 60 actually. So it's 60, sorry. That was an error. So it's actually 60. Sorry about that. It's actually 60. So that's 60 there. Sorry about that.
Then the one on top too has to be changed. Less debt repayment, 60 million, not 69.
Yeah, that's true. That's true. That's true.
Then
So
my
this,
second question, should I hold on?
yeah, go on with it. Go on with it.
So my second question is, why are we using profit after tax? Why didn't we start with profit before tax, less interest, less taxation?
Profit before
Because when I
tax.
did it bit by bit, I wasn't getting 188 something.
Okay, hold on. Hold on. Hold on. So you were saying something. You said your that we should have
For
started with
the free
profits.
cash flow to a with profit before tax.
Okay, that why are we doing
That why are
profit
we
before tax,
starting
right?
with profit after tax? Yeah.
It's the same thing now. You know that if you pick your profit before tax, before interest and tax, right?
Yes.
You pick your profit before interest and
Mm-hmm.
tax, you need to minus
Mm.
your tax, you need to minus your interest. Because we are working on free cash flows to only equity. We need to pay off all the debt holders. And whether we are working on free cash flow to equity or we're working on the normal free cash flow, we need to pay tax, right? So that means that is non-negotiable. So what do? Instead of us to pick our profit before interest and tax, where we know that the free cash flow that we are going to have left does not belong to the debt holders. That means that we need to pay interest, we need to pay tax. Why not go and take your profit after tax to show that you have paid your interest, you have paid your tax? Is it not the same thing?
Okay, so are you suggesting that we should just pick the profit after tax instead of calculating profit before tax, less interest, less taxation? Because when I did the calculation, I was getting 179.7 as my profit after tax after doing all those calculations.
Yeah, so this is what you do, right? The calculation they've done it for you here. So why are you doing it again?
Okay.
They've done
So
it
we
for you
should
here.
just pick this.
Just pick
All
your
right,
profit
no
after
problem.
tax and move on. Right? That's what you should
All
do.
right,
Just pick your
thank you.
profit after tax and move on. So they've done it for you already. So that's just it. So therefore, I want to check for, yeah. So look at our interest chargeable is 24. So what they did here is that they now say 1 minus the tax rate. The tax rate is 35%. So they now say that because we are starting from, what's it called? We are starting from the last place, which is from our, yeah, from this our last answer. When we sub this one, you know that the only difference here is that we didn't take into cognizance our interest. We also didn't take into cognizance our loan repayment. So those two things. And remember, there's another thing. There are three things to consider. Check the question that there is loan, there's interest, loan interest. Also check the question that there is loan repayment, and also check the question if there is the actual loan you collected. Okay, so those three things are what you should always put in mind. So when you have done that, then so yeah, we are starting from the answer we got here, which we are picking it, and we are coming over here to come and work. So we now say, okay, These are free cash flow actually. Since this is our free cash flow, then to anybody, these are free cash flow to everybody. So what do you want to do? We want to now say we need to take away the debt holders. Let's settle the debt holders away. So what do? We now say, okay, normally the loan repayment, we can remove it. There's no issue with that. But our interest naturally should be our interest should actually be our, what is that place? Let me see. I think this is it. Our interest charge should actually be this amount, which is they didn't give us any percentage, just give us the interest in the question. So now this interest in the question normally is supposed to save us tax, because we normally say our profit before interest and tax. We now minus our interest. We now have profit before tax, right? So we now minus our interest, we now have profit before tax before we now use it for our computation. So that means naturally interest payment ought to save us tax. So, and the interest amount is actually 24 million. So how do we now get that tax, that savings that we could have gotten from it? How do we get that savings that we could have gotten from it? So what do? We now say, okay, we now say the interest we want to deduct will now be 1 minus the tax rate, to show that we are taking the tax element, we are saving that tax element away. That savings that it could have given to us, we are also considering it. That's what we're saying, times 1 minus tax rate, which is this value, okay? And that is how we are able to adjust and get this value over here. So you can see that this value is the same value as what is here, no difference. Any question? Any question? Now for our dividend cover or dividend capacity is a measure of assessing the ability of a company to pay dividends. And the ability of a company to pay dividend can be calculated by using the dividend cover. Dividend cover assesses the number of times a company can pay dividends. So in the question, you already calculated your dividend, your free cash flows to equity. Now, if you want to get dividend cover, please, I repeat, please don't use free cash flows to the company. If you're using free cash flow to the company, you are going to make a very big mistake, because when you're using free cash flow to the company, you are not, this money does not belong to only the equity holders alone. So it's like you are using the money that does not belong to the equity holders, and you are using it to calculate dividend for the equity holder. So you can never get a good answer. So what you should do is that whenever you want to get your dividend cover, make sure it's the free cash flow to equity that you are using, because is the equity holders that also take dividends. So at last, you now say your free cash flows to equity, which is going to be our 89.18 divided by our dividend payable in the question. Where is that? Dividend payable is actually, let me see. Yeah, 30 million. So that is what we did here. And yeah, that's what we did here. That is what we did here. Is that noted, everybody? We have about 9 minutes to go. Okay, we have 9 minutes to go. So if you have any questions to ask, because after this time out, we are going to have our audit class coming up. And the audit class is going to be for 2 periods. So I'm not sure the auditor or the audit tutor will stay all through the 2 periods. I'm not sure, but at least let's just have that at the back of our mind, that it's possible to have a double period for that class. Does that make sense to us?
Yes, please.
Okay. All right. So let's now Let's now move on. Okay, let's move on now. The next thing we are looking at now, we are looking at valuing a firm using free cash flows. Value a firm, valuing a firm, right, using free cash flows. That's what we're going to do now. So the first one we've done free cash flows and all that. Then the next thing is that we want to now see how to value a firm using free cash flow. So let's quickly rush through it before our time goes up so that we can see what we have. So this is actually the major work when you start valuing a firm, because when you are looking at mergers and acquisition, valuation, company valuation and everything, you need all this information, because when we go straight to merger and acquisition, this information you have here is going to come in very handy, because you need to value a business, right? So now, valuing a firm using free cash flows. So they say this method values a business as the present value of future free cash flows. Okay, so you already know how to get present values, and you also know that if anything is in the future, you need to discount it to the present. Okay, so they say this method values a business as the present value of future free cash flows. The discount rate applicable should be the rate that reflects the level of risk attached to a cash flow. Corporate value is calculated as the present value of free cash flows using the weighted average cost of capital, which is WACC, as the discount factor. So to get corporate value, the value of the business, okay, to get the corporate value, you are going to take the present value of the free cash flows to everybody. You know, we have free cash flows to everybody. We also have free cash flows to only the equity holder. So you are going to take the present value of the free cash flows to the equity, sorry, to everybody. Then you are going to discount it. So hold on. Yeah, so present value. Yes, so you're going to get, you calculate, yes, so you calculate the present value of the free cash flows. So what are you going to use to discount it is that weighted average cost of capital that you're using to get the present value. So it's as easy as that, easy as ABC. So what's the formula? Corporate value equal to value of equity plus value of debt. That's how to get our corporate value. So most times when you use your free cash flows to everybody, you are getting both the corporate value and the debt value. But let me not be too fast. Let me not be too fast. Let's take it one step at a time. We now come here, they say, therefore, value of equity equal to, yeah, so value of equity now, it becomes the corporate value minus the value of the debt. So therefore, it means that in this corporate value, we have both the value of the equity and the value of debt together. To now be able to get only the value of equity alone, you simply minus the value of debt from the value of, for the corporate value. Alternatively, value of equity can be calculated as the present value of free cash flows to equity using the cost of equity as the discount factor. I think we have 4 minutes to go, and we need to leave this for later. Let's leave this for later. We are going to look at value of a company from next time. So that is that. Any question from anybody? Any question? Any clarification? Any addition? Any subtraction? Are we together?
Yes, sir.
All right. So I want to believe that there's no question from anybody. So therefore, we can call it a day. So get set to join your advanced audit shortly. Bye-bye.
Bye.
Bye. Thank you.